Hello and welcome to our channel. Understanding the events that led up to the crash of 2008 is crucial in order to deal with and take advantage of both recession and inflation times. Similar cycles seem to happen about every 10 years or so, as we have seen in the recent collapse of the Silicon Valley Bank. Both events have different forms, but the fundamental patterns that lead to both crises are the same, like easy access to credit after a recession, financial institutions and investors following the hype and making risky investments based on short-term vision. Then, the Federal Reserve raising interest rates to combat inflation, leading to a collapse. So, let's dive in. Before the 2008 financial crisis, interest rates were relatively low, which helped fuel the housing bubble. Many people bought homes because they were lured in by the prospect of quickly rising home prices and the belief that they could flip the property for a profit. Additionally, lenders were offering adjustable-rate mortgages and other exotic loan products that made it easier for people to qualify for a mortgage, even if they could not afford it in the long run. These loans often had low introductory rates that would later reset to much higher rates, which many borrowers were not prepared for. As the housing market continued to heat up, the demand for housing continued to increase, which further fueled the rise in home prices. Many people saw the value of their homes increasing rapidly and assumed that this trend would continue indefinitely, leading to a speculative frenzy in which people bought and sold homes purely for the purpose of making a quick profit. Lenders and financial institutions made risky loans and bundled them together to sell as mortgage-backed securities to investors, spreading the risk throughout the financial system. Even with the increasing interest rates, the lenders would be able to recoup their losses by selling the foreclosed homes at a profit. This attitude of assuming that housing prices would always increase, coupled with the ease of obtaining a mortgage, led to a situation where many people who could not really afford to buy a home were given mortgages anyway. There were several reasons why lenders made it easier for people with lower incomes and credit scores to obtain mortgages during the housing boom. One reason was that they were able to package and sell these mortgages as securities to investors, which allowed them to make a profit while passing on the risk to others. This created an incentive for lenders to issue as many mortgages as possible, even to people who may not have been able to afford them. Housing prices became overinflated due to easy access to credit and a speculative mindset that drove up demand. The Fed began raising interest rates in 2004 and continued to do so until 2006, which contributed to the increase in mortgage rates and the decrease in demand for homes. Additionally, some subprime mortgages had adjustable interest rates, which meant that as interest rates rose, the monthly payments on those mortgages also increased, making it more difficult for homeowners to keep up with their payments. This led many people to default on their mortgages, meaning that the lender would put their property on sale. This increased the available houses even more and drove the prices down even further. Many homeowners were unable to sell their homes, refinance their mortgages, or make their mortgage payments, leading to a wave of foreclosures and distressed property sales. As a result, the demand for housing decreased, which in turn led to an oversupply of homes on the market. With more homes available than there were buyers, sellers were forced to lower their prices in order to attract buyers. This downward pressure on prices was further exacerbated by the increasing number of foreclosures and short sales, as distressed homeowners were unable to keep up with their mortgage payments and were forced to sell their homes at discounted prices. All of these factors contributed to the dramatic drop in housing prices. At the same time, the mortgage-backed securities that had been sold to investors began to lose value as the underlying mortgages began to default. This led to a crisis in the financial industry, as many banks and other financial institutions that had invested heavily in these securities suddenly found themselves facing huge losses. The resulting credit crunch made it harder for people and businesses to get loans, which further slowed the economy and contributed to the housing market's decline. As a result of the crisis, many financial institutions went bankrupt or had to be bailed out by the government. This led to a loss of confidence in the financial system and a significant drop in stock prices. Many investors lost large sums of money, including retirees who had invested their life savings in the stock market. The crisis also had a ripple effect on the broader economy, as businesses began to lay off workers and cut back on investment. This, in turn, led to a decrease in consumer spending, which further weakened the economy. The effects of the crisis were felt for years afterward. The unemployment rate remained high for several years, and many homeowners who had lost their homes during the crisis found it difficult to buy another home due to the tightening of lending standards. The crisis also had a lasting impact on the financial industry, as regulations were put in place to prevent a similar crisis from occurring in the future. What do you think the similarities were between the 2008 financial crash and the recent collapse of the SVB Bank? Please share your thoughts in the comment below. Please do not forget to subscribe if you like this type of content.